Good afternoon, everyone. Welcome to the ET Markets webinar on which are the sectors to look at for the next bull run in the market. IT and pharma were the best equity stories of the last decade, while realty ruled the roost in the pre-Lehman crisis days. But all that is old news now. We have with us Mr. Sampath Reddy, CIO, Bajaj Allianz Life Insurance, to tell us which sectors will lead the next big rally in the market. Mr. Reddy will make his presentation first, which will be followed by a question and answer session. Please note that our expert will name the best participant of the session at the end of the webinar, and the winner will take home an ET Markets laptop bag worth rupees 3,200 as prize. I would request all of you to keep posting your questions in the small chat room on the right side of your screen. We usually get a lot of questions during the session, so the faster you post your question, the better chances are of them being answered by our expert. So here we go, the presentation first. Over to you, Mr. Reddy.
Okay, thank you, Uncle. This is Sampath from Bajaj Allianz. Just before I will give you the I'll have a few slides of presentation, and after that we will take it question and answers. Here is the India's GDP growth, which has been accelerating of late. Latest quarter the GDP has grown by 7.4%, and which is basically led by the manufacturing and manufacturing activities. The nominal GDP is now back into the double-digit growth path. Especially the nominal GDP is very important. For the most of the corporates, the measurement of the top line is broadly linked to the nominal GDP growth of the country. So that is coming into the double-digit growth path, which is very encouraging sign. And real GDP is also picked up. So that is that is also a good sign. And if you look at the compositions of the GDP growth rate over the years, how it has been, so far still the consumption is the key driver of the GDP growth rate. Of course, government spending is also adding, but it's still very small. The bigger component which can drive the GDP growth at a much faster pace is the investment side. That continues to be the drag, especially if you look at the private sector investments. They continue to be lackluster, and in fact they've been a negative contributor to the overall GDP growth. So the so far the trend seems to be the consumption is going to drive the growth, but we expect very soon the investment also will add to the growth path. That's the tricky question: by when do you see that growth infrastructure and investment side will be the big question mark. This is the index of industrial production growth. This is again showing a small uptick after several months of near zero or negative growth rate. Slightly there are some positive signs of growth coming back. So industrial production is yet not showing any major improvement. I think this is another important indicator for us to watch. This has to grow well for us overall to see the most of the corporate show good earnings growth. This is the overall credit growth in the system. The India overall credit growth has come down to nearly about 9 to 10%. The credit growth used to be in the range of about 20 to 25% during the good old days. That has been consistently coming down. That is mainly because of the lack of investment activity, which we have seen in the previous slide. The investment contribution to the GDP growth has been very, very small, or in fact to the negative. So that's the reason why the credit growth is still continues to be poor. And whatever the growth that we are seeing in the credit, most of that is actually coming from the retail credit growth, which is in the form of home loans and other personal loans. So that is what is still driving the growth. That growth is still about 19-20%, but the corporate credit growth continues to be weak. So that is also an important indicator for overall to see how the growth is happening in the country. And only thing is that's also looking up. The credit growth is also likely to pick up. So here again, it's a most of the people in most of the banking sector, which is exposed to the corporate loan segment, they continues to show poorer growth, whereas the companies which are exposed more towards the retail loan side, they continue to show good numbers. Overall corporate earnings growth seems to be looking up, especially for the quarter four. There seems to be a good pick up in terms of earnings growth. Earnings have grown. If you adjust for some of the companies which have got one-time hit, like some of the financials, like state-owned banks, they had to take an excessive provision because of some asset quality issues, and some of the metal companies also have shown losses in the previous year. Because of that, I think the overall the earnings growth appear to be muted at the overall index level. But if you adjust for these one-offs, which are cyclical downturns, the growth in the steady segment, is in the range of about 14%. Most of these issues which dragged the earnings in the last financial year seems to be now behind. I think this financial year, we could see the earnings growth coming back to 17-18%. The inflation, which was a big worry, I think that is certainly under control, especially the CPI inflation, which used to be in the range of about 7-8%, is now successfully tamed down to about 5 to 6%. WPI is not really a big worry. WPI has been in the negative territory for almost 2 years, especially because of the commodity price fall, especially things like crude and other metal prices. That is also now looking up and coming into positive territory. But what is more, RBI is focused on is the CPI inflation, wherein which the monetary policy is anchored around the CPI inflation. So that seems to be certainly under control. If you look at our overall balance of payments, on the fiscal and the financial side, we're doing pretty well. Balance of payment continues to be good, led by the FDI inflows. FDI inflows continues to be strong. Overall, in the last couple of years, we've also saved a lot of money in the form of current account deficit. Current account deficit has come down dramatically. So because of that, overall balance of position of the country is pretty good. FIs were net sellers in the last financial year, including all the portfolio investments taken together. But that is, if you have to see in the year before that, there was a big buying. So there will be a little bit of cyclicality in the FI flows, but FDI continues to be on the rising path, and the current account deficit is also under control. So overall, India's balance of position is pretty good. If you look at the RBI policy, monetary policy, they've been lowering the rates, interest rates, to kickstart the growth. Even in the last policy, which is in the April, again, they've acted, reduced the repo rate by another 25 basis points to 6.5%, and even the LAF corridor also has been brought down to 50 basis points. RBI has been always been mentioning that they've been watching the liquidity very carefully and providing ample liquidity for the industry for the growth, and at the same time bringing down the interest rates gradually. So overall interest rates have come down. RBI, especially RBI repo rate, from over 8% to 6.5% in the last 2 years. I think we could see some more reduction coming in the RBI rates. I think that will bring down the interest rate somewhat more, which probably should lead to the overall recovery in the demand. This is the sector performance in the last 10 years. If you look at the Nifty, in the last 10 years had given a 10.23% CAGR for the last 10 years. And if you look at the performers, basically the banking was a big winner, and pharma and IT and the automobile and consumer sectors have also done very well. These are the sectors which drove the overall market performance. Within the banks, you see the private sector banks have done exceptionally well. They're at 22.7% CAGR in the last 10 years, and pharma also has done exceptionally good. Then consumer durables and consumer, and followed by the IT and the automobile and IT. So these are the sectors which have done well. The things which dragged the rather underperformers were mainly the metals, wherein the commodity prices have come down because of the Chinese slowdown, and also the telecom sector has also been a relatively poor performer. That is again led by the intense competition and sort of maturing in terms of penetration, and as well as the voice growth. Okay, so that is also led to the a little bit of underperformance there. Let's see. It's interesting to see what will what are the big sectors which will drive the growth for the next 5 years or a 10-year period. See, before coming there, just relatively how are we placed in terms of the market overall valuation. One of the important barometer of measuring the market valuation levels can also be market cap to the GDP ratio. What happens is in terms of PE ratios, at different is at times PE ratios could be very high and the market could be very attractively priced, and vice versa. The reason being is that if the companies are not at its optimal profit levels, if the profits are depressed, let's say, during that period, the PE might appear higher, and but actually the market could still be cheaper. Those kind of anomalies are there in the traditional valuation method. When you look at the larger market as such, probably India, market cap to GDP can also give you a little bit of a better picture. If our own market cap to GDP ratio in the past, let's say 10 years, if one looks at it, the average range seems to be in the range of around 80%. Today we are below the average. That could be an indication of attractively priced market even today. So in the peak, during 2007-8 peak, it went up to 147%, and if you look at the same ratio for some of the developed countries, it's over 100%. I think that is mainly because in the developed countries, more and more companies and services are in the listed space. That's why probably their market cap to GDP ratio is on the higher side. It does not mean that they're expensive, but the way to look at this chart is our own market cap to GDP over a period of time is a better way of reading this chart. In terms of the very often looked at question these days is how are the mid caps have been relative to the large cap. If one looks at it in the last couple of years, last 3-4 years, I would think mid cap companies have been moving up much faster. I think the mid cap indices have done much better than the larger cap indices. That's having said that, if one were to look at the relative valuation, I think mid cap companies as such are slightly on the higher side in terms of valuation relative to its own valuation parameter. So overall, larger cap companies probably seems to be a better bet at this point of time. Usually what happens is, when the economy is turning around, when the earnings are growing at a good pace, rapid pace, that is during that period, mid-cap companies will have a larger growth in earnings because of its small base, and also generally they have a lot more leverage, operating leverage. But because of that, the mid-cap companies generally end up growing very fast in earnings in an economic upturn scenario. I think most market participants have been positioning for this economic recovery ever since the change of government has taken place last 2 years. I think people have been a lot more optimistic in terms of earnings growth, and they've been positioning accordingly. I think that's why you see overall the mid-cap companies have done well, and also slightly trading at a higher end of the PE multiples. So if you see a good recovery in earnings growth in terms of overall economic earnings growth and as well as corporate earnings growth, usually mid-cap companies might grow earnings a little bit faster than the large cap companies, and that's what that's why most of the participants have been positioning towards mid-cap companies. And that's one of the reasons why the valuations are on the higher side. So we have to be, trading this, mid cap versus large cap, a lot more caution, and we've got to keep watching the numbers very carefully, performance of the companies very carefully, and invest, accordingly. And that's that's how I would put it and leave it there in terms of large cap versus mid cap debate. Another trend, which is another data point that is of late is having an impact, or could have an impact in overall consumption-led growth, is the seventh pay commission-led spending. With the cabinet approval of the seventh pay commission, we could see a increased amount of disposable income among the employees of the government employees. Usually historically, whenever these things have happened, there has been a pickup in the demand, especially in the consumer durables. That I think we could see that again this year as well. Even otherwise, consumer durables overall, as a sector, doing pretty good, are at the inflection point. That we will come in the subsequent slide. We will look at it. Some of the sectors where the good growth is happening, or rather growth potential is very good, and have now come to the inflection point. These white goods or consumer durable goods as a space has come to more like an inflection point, and wherein the growth is accelerating at a good pace. If you look at the penetration of air conditioners per se in the country, it is very, very low. It's relative to most of the other Asian peers as well. Even if you look at it, our penetration is much lower. And given that we are especially country which lies in the hot zone, our AC penetration is exceptionally low. Similar TV is a reasonably penetrated segment, but other white goods such as refrigerators and washing machines, even if one were to look at that, I think the penetration levels are lot lower. And India is as such, because of several years of economic growth, overall rising income levels, and we have come to the inflection point where all of these white goods are sort of a necessities. They are no longer sort of a luxury items. All of these have become part and parcel of every individual household. I think that is what is going to drive the segment growth, and so this could be one of the sectors one could look at in terms of for the next 5 to 10 years. And similarly, all kinds of washing, white goods, and one can look at it. Similarly, washing machine, as we discussed, the penetration is quite low, and the sector continues to do well in the last 5 to 5 years, in the last 10 years, and we could continue to see the similar kind of a growth coming in the next few years. This is again for the refrigerators. Again, volume growth continues to be good in this space. This sector also will continue to do well. Another trend which we are seeing, which could have a continuous sustained structural growth kind of a thing, is again building materials and home improvements. With the real estate boom that took place a few years back, the affordability of housing has gone up, and now there have been several nuclear families, and now all of these families are actually in the have come to the consumption zone, and they are now leading the demand for various home improvements and building material kind of products. Some of them, which could be whether it could be sanitary ware, or it could be plywood, or it could be paints, or it could be fans and electrical wire and switch gears. Some of these products continues to have exhibit a very structural growth in the last several years, and would continue. We would see that same trend continuing at least for the next 5 years or so. This segment could be a very interesting space to watch. This is the data which shows the share of organized versus unorganized sector. So far in the last few years, most of the the products or segments in this space was dominated by a fewer regional players, or smaller unorganized players. With the scale and size growing, we are seeing bigger and bigger companies emerging, and they're becoming an sort of a pan-India players, and are becoming a national brands. That is, I think, a bigger change which is driving some of these companies. Several of companies such as you can see Havells or Avigard, or some of these companies were a small regional brands over 5-7 years back. Today, most of these companies are sort of a national level brands, and the another in addition to the natural demand growth, this segment is basically moving towards more of a organized market, or the bigger and bigger corporates are taking a bigger market share from the unorganized players. I think that will also add to the overall earnings growth for these companies, in addition to the the natural demand growth. I think because of that reason, this sector is very interesting to watch for. Some of the measures like GST, if it were to be implemented, that would also help the organized players more than the unorganized players. Overall, I think this sector you could find many interesting investment opportunities. We have seen plywood in again which are a couple of companies are there in this space, which are predominantly competing with unorganized sector, can pretty much do well. Paints is again another interesting sector with very few players controlling the market, and have had a sustained growth over several years, and we don't see any reason why, in fact, the similar growth continuing for the next 5 to 10 years. And as you look at as the affordability increases, people are changing the furniture, changing the paints more often, and that is also replacement demand is actually driving and higher affordability, higher premiumization of, and are driving the growth in this sector. Another interesting sector at this point, I think, if you look at as I shown in some of the previous slide, telecom was a drag in the last decade. The underperforming sectors, maybe this sector could be looked as a turnaround opportunity, turnaround sector, and penetration is, telecom penetration have hit pretty much like saturation levels, and if you look at the voice revenue growth, that is also pretty much at the saturation levels. But what is driving the sector is basically the data revenues, which is, I think, is on the rise, and the data penetration level still continues to be low. I think with the WhatsApp and Facebook and so much of usage of internet and the phones, we could see a lot more growth in the data. And in addition to the data growth, the telecom industry as such, because of its poor profitability in the last few years, has been seeing sort of a consolidation signs. I think that's once probably we could see that happening in the next probably 1 to 2 years. With that happening, the pricing could also improve. Pricing already seems to have bottomed out, and there are some signs of improving the pricing in the telecom space. With that, if that were to happen, I think telecom could see a good rebound in terms of share prices. This could be an interesting turnaround sector to watch for. Metals again, metal, because of the overall excess capacities and the China slowdown, metal prices have been under pressure, but I think inventories seems to have been on the downward spiral for most of the metal products. I think once you will see the inventories draw down, then we could see the metal prices moving up. The metals could be again another turnaround story. One could look at it in terms of metals. This is another. This is the one which has done very well in the last 10 years. I think probably will continue to do well for the next 5 to 10 years. Private sector banks. Private sector banks continues to do well, and they have been growing in the region of about 20 to 25% in terms of their loan book growth. And in spite of lower credit growth overall in the system, this segment, private banks and private financials, have been growing at a very good pace. That is because the dominant player, which is the PSU banks, they continues to be under pressure. They are lacking with the capital support. They are behind the curve in terms of technology and service. So because of these three reasons, PSU banks have not been able to grow, and PSU banks, which account for about 70-75% of the industry, they are not growing, and the private guys, which account for about 20-25% of the industry, and they are actually taking away the market share from the public sector banks. I think that trend will continue for some more time, and because of that, you would see much better growth for the private banks. So overall, private banks is another segment where one could look at for stay invested for a longer period of time. Yeah, I think that has come to the end of my presentation. Uncle?
Thank you, Mr. Reddy. That was quite an elaborate presentation, I must say. We have quite a few audience questions for you. But before I start, I would please let me remind everyone that our expert will pick the best participant at the end of the webinar, and the winner will take home a branded laptop bag worth rupees 3,200 as a prize. So, sir, I will start with the first question today. Mr. Prashant Singh says, the first point is, are we really in a bull market? We hit 8,700 and then fell back to 6,700, and we called it the end of the bull run. And now we see a bull market again. What is it all really about?
See, I mean, it's these are the bigger terms. People use structural bull markets and stuff like that. I would put it this way, investor like you and most of our clients, we suggest that one has to have a systematic approach of investing and saving, and markets will have the ups and downs. There will be periods where the markets at times overprice the future potential, and at times significantly go below the intrinsic values. I mean, today at this point of time, I would think that given the economic potential and growth of our country, we could continue to see even from the current level about 15% kind of a returns from the markets. And yes, the biggest risk to that is whether earnings revival in this year will happen or not is a bigger question to look for. I mean, most of the market participants, including we are of the opinion that this financial year will be a turnaround in terms of corporate earnings growth. In that backdrop, I think market will continue to do well from current period onwards. Having said that, the markets could have ups. In addition to our own economic fundamentals, there could be external events. There could be some of the events which could derail these growth for a shorter period of time. But I think the overall India continues to do well, and we have a good growth potential going ahead.
Okay, thank you, sir. The next question is from Mr. Ravi Chandra TK. He wants to know, do you think infrastructure is the best bet to gain faster in the bull market?
No, not necessarily. I mean, it is not driven by what was driving last bull cycle was actually the infrastructure. Infrastructure has done exceptionally well. Several of the companies have become multi-baggers in that last previous bull market. It is not necessary that same thing holds true for this bull market. Every time new things will emerge, new growth drivers will come forward. We have to keep identify them, keep watching out for them, and and see which one will turn out to be the true winners. I mean, it is not. I would say it is like it's not like one statement fits that stay invested in infrastructure, so you will be a big winner for the next 5 to 10 years. It's not that way. It's not that simple. But investment is a profession, day-to-day activity, and you've got to keep monitoring them. Macroeconomic fundamentals and company-specific issues, and see where the growth is happening, which all companies are doing well, and stay invested in those good companies. That's how one should position, I would say.
Okay, thank you, sir. The next question is from Mr. Karan Arora. He says what to look at to identify growth sectors in the economy.
Yeah, I mean, these are all, you have to identify and see which all segments the growth is happening, what the companies are doing, whether the companies are in an investment mode, what the companies are saying, how the sales are panning out. This is how go and try to identify the segments where the growth is happening. It's like, the top-down approach. You analyze the macro first, and within the macro, which are segments which are driving the growth, which are segments which are continues to be on the downward cycle, and from there you dig deep into the segment, the further sub-segments, and then you draw down into some of the zero up on into some of the segments which are growing. It's like a macro approach. At the same time, one has to do a large amount of research and see and talk to the companies and industry participants and see how what their plans are, what the demand growth projections are. From there, you will come and you will identify the growth segment. Like for example, today, we as a team, with the help of other market participants, cover over hundreds of companies, and from there, we see which all companies are growing and which all companies are not growing, and from there you will see, putting them together, then you will get an idea, which all segments are growing and which all segments are not growing. So it's a little bit of a macro top-down, and also coupled with bottom-up approach. So taking together all in both the processes, then you will get an idea what all segments are growing. Otherwise, it will be difficult to say from a mere external market participant. It will be difficult to identify which all segments are growing.
All right, I hope that answers Mr. Arora's question. We have a very ambitious question from Mr. Devesh Kothari for you, sir. He wants you to tell us 10 stocks that should run ahead of the others and 10 much talked about stocks that you are not too bullish on.
No, I think that's difficult to say. I mean, as such, like we would refrain on talking on the company specific issues. But let's say we've talked about the sectors, for instance. Some of the companies in that space, like private sector financials, could continue to do well, and you can pick, and there are a whole host of maybe 10, 15 companies. By and large, most of them are doing pretty good. You can easily pick some of them from there. And also, we mentioned about the building materials and home improvements and paint companies. There also, again, the number of companies are not too large. One can identify a couple of good companies and construct a portfolio from there. Like that, from the sectors which we've mentioned and discussed, there one can easily identify a 10 set of companies and pick those companies from there.
Okay, I think that was a very decent answer for you, Mr. Kothari. The next question is from Mr. Partha Pandey. He wants to know what is the range of the market rally that you are forecasting, and which are the sectors, which are the key sectors. Say, would you pick up 5 sectors that are in focus during this rally?
Right. I think just there is not like this rally and next rally, and because market, if you put a chart, there will be several rallies and corrections, depending on how big is a rally and how small, how much deep fall is a correction. Based on that, it will be there will be several rallies and several corrections. But having said that, today what we are more bullish on, what we are more optimistic on, are some of the sectors which I've discussed. It is private sector financials. I mean, as I said, some of the companies, some of the sectors like telecom can also be looked as a turnaround sector. These are the ones which one should building materials and home improvements continues to do well. These are the sectors one could stay invested, as the growth continues to be very good in this sector, and there are good companies available in this sector, in this space. That's what one should be focusing at. It is not that this rally is not like, I would say, 2003 to 2004 to 2007 infrastructure or capital equipment driven rally. It is not like previous technology led rally. It is a generic India consumption led growth story which we are looking at, and we are also trying to see if and when the investment cycle picks up, how to pick up stocks from that segment as well. So that's what today in terms of market positioning wise.
Okay. So the next question is from Mr. Amol Mahapatra. He says, how are new technologies impacting IT and pharma, and how can one quantify ROI linked technological upgrades to business impact?
Yeah, I think the new technologies are today what is hurting. Let's say, for example, pharmaceutical sector. Pharmaceutical sector is mostly bogged down with the issues with the FDA. So that's where it is taking a hit, but not really a major technology issue there. But in the IT space, again, some of the more on a generic growth issue, but not really much on the technology kind of change. I mean, by and large, almost all of Indian IT services companies are are on the forefront of the technology. The moment any new software tools gets released, immediately our companies assimilate that. It's not the technology obsolescence per se which is hurting them. It is overall IT spending which is matters for the IT companies for in terms of overall growth and performance. And always these companies, especially the important selling point for IT companies is return on investment. If a company or a corporation or a bank or financial institution is investing in a software, or IT systems, is it helping the organization overall in terms of its profitability and saving in terms of costs and things like that kind of measures. So our return on investment is an important selling tool for the IT companies. I mean, as long as the customers get a good return on investment, you would continue to see the growth for IT services. I think that is a key focus element. I mean, I think with the the kind of world which we are in today, I mean, I think demand for IT continues to be on the it is no longer a sort of a option. I would say it is a sort of a necessity to not only to to save cost and be efficient, but it is like sort of in most of the industries it is becoming a sort of a medium of doing business. So because of that, I would think the demand for IT continues to be good, and there is not really much of an issue in terms of technological threats for by and large, and ROI has been the focus for selling for all of these companies. I think that as long as that is healthy, you could see the demand for IT services.
Okay, thank you, sir. The next question is from Mr. Sagar Singh. Since you spoke about being bullish on private banks in your presentation, this question seems actually apt. He wants to know, are our banks actually capable of competing with international banks?
Yeah. Actually, the our banking is not really that technology intensive, and especially the international banks, do not have any great technology. In fact, the technology of our banks, our private sector banks, is a lot more, I would say, modern and up to date. And so, and it's the management and people. It's basically our managements are exceptionally good. They have shown. In fact, if you see the overall private foreign banks and international banks, they have not been able to compete with very well with our private sector banks. Rather, in spite of the competition, the growth opportunity is so big there. For them, given that the poor financials of the public sector banks, the private sector banks continues to do well, and international banks, is no longer a big competition. Their presence is very, very small, and already they have demonstrated that Indian banks stands much better relative to the service as well as reach, technology. In all aspects, Indian banks have done much better than any of the international banks. It's already tested and proved. So there's no issue of our banks competing or successfully with international banks or not.
Okay, thank you, sir. The next question is from Mr. Kiran Kumar. He wants to know which is the best sector to invest in for the long term, irrespective of market conditions in the short term.
Right. Generally, if you want to look at it, if one were to look at it from the longer term perspective, and with respective of cycles, some companies which do reasonably good are, I would say, consumer kind of companies. They have done pretty well in the long period of time, irrespective of market cycle. I think this segment, this is the only segment which I think stands out as a sector which normally does reasonably well over a long period of time. So outside of that, there are examples of some companies doing very good even very long period of time, which could be our private sector finance, HDFC Group, and other private sector companies. They have also done very good. But I would think the consumer stocks, generally have done well in a longer period of time as a one segment if one were to look at it. So that's the only one I would say.
Okay, so the next is another interesting question. There is a lot of talk about the next multi-baggers over the next 5 to 10 years, auto components, food processing, textile, or solar energy. Would you like to venture and give us your pick among this lot?
Sorry, what are the names you mentioned? Solar, you mentioned
auto components,
okay.
food processing, textiles, and solar energy.
Textile and solar energy. Okay, I think the solar energy. We've looked at that space. Government is also trying to do. Or rather, on the renewable energy side, government is also giving a lot of push. The amounts which are today, the capacities are very small related to the government's target for 2023. So overall, that demand seems to be very good, but there are very few options for us to play that opportunity, even if it were to take place. So most of them would be utilities. Again, there return on investment will be a big challenge. So I would have it. I do not think it's solar in a big solar. But food processing, that's again much talked about it. But I would say most of the food processing are part of you can say consumer companies, whether you call Nestle, for example, Nestle, which is so even Dabur. Some of these companies are, I would call, not really a food processing companies, but are also into the foods business. They could do well, and textile also could do well, but the textiles have been the problem with that space is there's too much of capacity creation happens every now and then, and that really distorts the the pricing power of the companies. But textiles, yes, the demand is good. Auto components is another sector. You have very good quality companies in that space. That will certainly do well. So in the sector, in the names that you have thrown up, I would think auto components would certainly stand better, and there are already good companies, and they could keep on growing, and they will become sort of global suppliers. I think that sector will be the better one. Food, as I said, like some of the food companies are already FMCG companies. It's a little bit of if you food processing, if one were to talk about more in the form of cold chains and stuff like that, I think that may not be a big growth. But if you look at the food branded foods or packaged food companies, they are already part of the FMCG companies, which continue to like them, and followed by the textiles and solar. Really, I really doubt whether there will be any big investment opportunities there at this point of time.
Thank you, sir. I actually venturing out into this question itself, which is your top multi-bagger pick? Was it part of this list, or you have another
I would
thing to
think,
venture out?
I mean, my sector picks would be from the things which have been mentioned so far. It would be from from the private financials. It would be from the home improvement and building material side, or it could be from the white goods and durable side. It will be more from that side, and also auto components would also, I would think, will be a good sector, Matt.
Sure. Thank you, sir. The next question is from Mr. Shyam Vasudevan. He says, I am a
Okay.
small-time investor with less collaterals for day trading. Which sector should I concentrate on this year?
Uh, no, I think the answer lies the same. The same sectors which have a lot better growth prospect in the longer period of time. One should continue to stay invested. It is again the same. Private financials. This year, could you can see, look at telecoms and metals as a turnaround sector, and some of these building and home improvements. These are the sectors which will do well this year.
Okay. Sir, I think this is, you've answered most part of the next question, but I would still go ahead and pose this question to you. Mr. Satish Jain says, if growth is consumption driven, construction, auto, retail and financial sectors should do well. What are your views on
it? Sorry, which all sectors he mentioned?
Construction, auto, retail, financial. I think you've individually addressed all these sectors before, but I would still.
Yeah, I think all of them are fine. Probably, especially the financials we've mentioned about it. Retail is again retail formats not being doing that good. Especially the return on investment is a challenge in most of these formats. I think that's why in spite of growth led by the consumption, it is actually the the products, producers of the consumer products are making money, but not the the retail chains per se. I think that's where the retail issue is, and the construction is again not the I would say consumer side kind of a thing. It's more of most of the construction companies in the listed space are actually are infrastructure construction companies. So they're not really the consumer consumer-led construction. And auto, yes, auto is also part of sort of consumption-led growth. I think auto comes under that. So the financials and the auto can be considered as a segment from the consumer-led growth opportunities.
Thank you, sir. The next question is from Mr. Anand Pujari. He says, will PSUs with both domestic as well as global focus do better in a bull market?
Sorry, which PSUs is it? Sorry, can you repeat the question?
Yes. Yeah. Will PSUs with both domestic as well as global focus do better in a bull market?
But why PSUs? I think it's a separate question. But when if one were to look at, let's say, companies whether focused both domestic as well as international will do well is a question. I think at this point of time we are preferring more and more of a domestic economy exposure driven kind of companies rather than exports. Exports are not that prominent. Most of the space where we see the exports are really facing some sort of headwinds because most of the global developed countries are under a sort of I would say contraction mode or economically not doing well or in the recession. So export demand has not been that strong. So I would think one should be looking at investing in companies which have got demand drivers linked to the domestic economy.
Okay. Sir, we have Mr. Rinkesh Shah. He says, I'm still tempted to look at pharma. What are your views on it?
No, I think that's fine. Pharma is today is facing some of the FDA issues, and as we see those companies resolving these regulatory issues, I think they will again start doing well. But one has to keep monitoring that process very carefully before picking the stocks from there.
Okay, sir, we have Mr. Shyam Vasudevan again. He wants to know what about the defense sector? Do you think it will witness a boom?
Which one? Repeat the question, please. What is the defense?
Yeah, what do you think about the defense sector?
Yeah, I think defense is again, lot of, it is much talked about sector. Government is spending a lot of money in the defense, and government is sort of trying to impose some rules to outsource from Indian companies and things like that. But having said that, there are not many companies where one could benefit from this. Most of these companies in this space, defense spending, will go to the international players. So I do not see much of an investment, opportunities there in that space. I mean, rather, let's say, even if you spend a lot of time studying the sector, and you could barely find one or two good investment ideas. So I would rather focus energies in some of the other sectors and identifying good companies and where with good growth potential. Do not see much of big winners coming from the defense side.
Okay. Sir, we have Mr. Viresh CK. He says, is the market driven by the US presidential elections and due to which the fund flows are happening with historically is the case during the elections?
I mean, I'm not sure how much is the U.S. presidential elections are driving the markets today, but that is one of the important event which is ahead, and how the election goes and who is going to be the president and what his policies are overall, will certainly have some impact on the growth, on the fund flows. But I think that will be too early to say at this point of time. I would do not attribute the current rally towards the ongoing U.S. election event.
All right. So we've flooded with a lot of questions today. I would take up two more questions for this session. We have Mr. Jayesh Chaudhary. He says, you talked about telecom industry, that data revenue is increasing, but what about the capex? What does one invest? What have to invest crore? They have to invest crores of rupees to be in the business.
Right. I think that has been the problem with the sector, and the government is taking away a lot of money from the telecom industry in the form of spectrum license fees. Of course, that is through the auction route. So the companies have been spending a lot of money in the spectrum and the capital infrastructure. That has been the drag for the sector. But I think all of these things too have coming to an end. Most of the capex for all of these companies is behind. Even the spectrum, with this round, which is with the next round of auction, which are likely to take place in the next couple of months. With that, you would see the most of the spectrum auction issues will be behind. You would not see any major spectrum-related outflows coming for the next several years. So overall, these two aspects are largely done and are behind the curve. And going forward, if you see some price improvement because of consolidation issues and all that happens, I think telecom sectors could pose a turnaround. So in spite of the, I would say, to answer to the question, most of this capex and the spectrum costs are all behind now. I think incrementally going forward, you see them not hitting the balance sheets as much as in the past.
Thank you, sir. We have Mr. Lakshmanan. He says consumer durables is an urban phenomenon as such, and will such demand be broad-based in the rural areas to give push to growth?
I think yes, that this is what has been sort of an urban phenomenon in the last 5 years back or probably 10 years back, but it is now penetrating more and more into the rural areas as well. The affordability is has improved a lot, and even today the not only the capital cost of purchase, one-time purchase price, even the running costs have come down a lot. Today, even if one were to use the air conditioning at home, relative to what it was about 10 years ago in terms of electricity bill, it is no longer that big pinch for most of the consumers. So a few years ago, if the AC used to be in a big drag in terms of rather it used to draw a lot of electrical power a few years back. Today it is no longer the case. The efficiency of the system equipment are also improved, and also the pricing and affordability is also gone up. So because of that, you are seeing these products penetrating into the rural area as well. So that's what will drive the growth.
Thank you, sir. I said two questions, but I'm tempted to take this last question. This is a question from Mr. Madhavan Vardarajan. He says, should logistics stocks be bought only on the basis of GST? Should that not be considered for long term? What's your take on the subject?
Yeah, I think I think logistics need not be just looked at from the perspective of mere GST. I mean, it can be it has to, because the GST it will be a one-time event. It will be done very soon, and after that, what next after that? If one were to talk about from a 5 to 10 year perspective, it's just not one event, but even on its own merits, one has to look at it. Logistics as a sector, yes, I mean, there could be some good companies in that space. One should pick up some good companies in that where return on capital employed is good. One can buy on that. With respect to the GST, one will make a good return from there. But yeah, as a sector, need not be looked at merely from a GST angle.
All right. Thank you so much, Mr. Reddy. We have not been able to take a whole lot of questions for the dearth of time, but for the ones that we have been able to take, I would request you to announce the winner of the best participant of the session.
Yeah, I think it's really really a tough one for me. I mean, in fact, while I was trying to frame the answer, I'm trying to remember the question. Sort of noted down some of the names. That's why you would have seen there will be a little bit of a lag towards the question, because I'm trying to frame whether this person should be pulled in that better question or not. But a lot of names are similar. A lot of questions are, I would say, similar, and there will be several such. I would say, barring 4 or 5 questions, I would say almost all questions are, I would say, are really good. But I'm going to just take a minute and see what all these I've noted down. Yeah, I think the one somebody asked about the consumer durables, whether it is going to penetrate in the rural area or it's only an urban phenomenon. That could be a sort of a question one can look at it. But as I said, good thing is about this question is almost all the participants seems to have heard the presentation and the views, and almost all the questions are around the the presentation and views. So that's why there are many such questions, but maybe I would give it to a question on the consumer durables, whether it's an urban phenomenon or it's going down the rural area as well. I mean, I missed the name of the person. Probably it could Mr. Lakshmanan, I guess, but I'm not sure.
Yeah, it's Mr. Lakshmanan. Congratulations, Mr. Lakshmanan. You will receive your prize shortly. And once again, a very sincere thank you to you, Mr. Reddy. I would also like to thank our esteemed audience, especially those who took part in it very actively. Please note that you can access the video of this webinar on our website, www.etmarkets.com. Also, for a link to the video and Mr. Reddy's presentation, do follow us on our pages on Twitter, Facebook, and YouTube. Thank you, sir, and thanks everybody. We hope to have you all back next week. Enjoy your day.
Yeah, thank you.